Hi, I'm Michael from Investor Talk. Today we're going to discuss how we can navigate the current volatile market environment effectively. So let's start with diversification. Now, moving on to asset allocation. Equities. Allocate a portion to large cap, mid cap, and small cap stocks. Make sure to consider both growth and value stocks to balance potential returns and risk. For example, you might combine S&P 500 ETFs for large cap exposure with Russell 2000 ETFs for small cap and mid cap ETFs like the S&P Mid Cap 400 ETF. Bonds. It's also important to include government bonds, corporate bonds, and municipal bonds to provide income and stability. An example would be using ETFs like the iShares Core US Aggregate Bond ETF, ticker symbol AGG, or the Vanguard Total Bond Market ETF, ticker symbol BND. Commodities. Don't forget to invest in gold, silver, and other commodities to hedge against inflation and market volatility. For instance, you could use Spider Gold shares, ticker symbol GLD for gold exposure. Next, let's talk about sector diversification. Technology. This sector offers high growth but comes with higher volatility. For example, you might consider the Invesco QQQ Trust, ticker symbol QQQ, or the Technology Select Sector Spider Fund, ticker symbol XLK, Healthcare. This is a more defensive sector with stable cash flows. A good example here would be the Healthcare Select Sector Spider Fund, ticker symbol XLV. Financials. This sector can benefit from rising interest rates. You could look into the Financial Select Sector Spider Fund, ticker symbol XLF. Geographic diversification. Domestic and international stocks include both U.S. and international equities to benefit from global growth. Example, iShares MSCI ACWI ETF or ACWI for global exposure. Emerging markets, higher growth potential, but, well, with increased risk. Example, iShares MSCI Emerging Markets ETF or EEM. Quality focus. Objective. Prioritize investments in companies with strong fundamentals to provide stability and long-term growth potential. Strong balance sheets. Criteria: low debt-to-equity ratio, high liquidity, and consistent cash flow. Example: companies like Apple, AAPL, and Microsoft, MSFT, are known for their robust balance sheets. Consistent earnings growth. When evaluating potential investments, it's crucial to look for companies with historical earnings growth, strong future earnings projections, and competitive advantages. For instance, Amazon and Alphabet have shown consistent growth over the years. Dividend stocks. Companies with a history of paying and growing dividends can be a solid choice for investors seeking steady income. Procter & Gamble and Johnson & Johnson are well known for their reliable dividend payouts. Additionally, dividend ETFs provide exposure to a diversified portfolio of dividend-paying stocks. A good example of this is the Vanguard Dividend Appreciation ETF. Growth and innovation. The objective here is to invest in sectors and companies driving long-term growth through innovation and emerging trends. Thematic investing. Technology and innovation. Focus on artificial intelligence, cloud computing, and other disruptive technologies. For example, ARK Innovation ETF, also known as ARKK, Healthcare Innovation Genomics, Biotechnology, and Personalized Medicine. A good example here is the iShares Genomics Immunology and Healthcare ETF, ticker symbol IDNA. Sustainability and clean energy. This includes renewable energy, electric vehicles, and sustainability-focused companies. One notable example is the iShares Global Clean Energy ETF, or ICLN. Emerging markets. Objective capture growth potential in developing economies. For example, you could invest in ETFs like the iShares MSCI Emerging Markets ETF, ticker symbol EM, or the Vanguard FTSE Emerging Markets ETF, known as VWO. 4. Risk management. Objective: mitigate potential losses and manage portfolio risk effectively. Regular portfolio review is, well, essential. You should aim to do this quarterly or semi-annually to, assess performance and realign with your investment goals. Rebalancing is a key part of this process. It involves adjusting your asset allocations to maintain your desired risk levels. For example, if your equity allocation has grown due to market gains, you might want to rebalance by shifting some funds to bonds or other asset classes. Hedging strategies. Options and futures can be used to hedge against potential market downturns. For example, buying put options on major indices or specific stocks. Inverse ETFs can also provide protection against market declines. One example is the ProShares Short S&P 500 ETF, often referred to as HH. Stop-loss orders. The objective here is to automatically sell positions when they reach a certain price to limit potential losses. For instance, setting a stop-loss order at 10% below the purchase price of a stock can be a prudent strategy. Specific investment examples. Let's go through a few scenarios. First, a balanced portfolio. This might include 60% equities split between large cap, mid cap, and small cap stocks with a mix of growth and value. 30% bonds comprising government and corporate bonds for income and stability, and 10% commodities and alternatives like gold, real estate, and other alternative investments for diversification. Next, an aggressive growth portfolio. Here you might have 80% equities, with a heavy focus on high-growth sectors like technology, biotech, and emerging markets. 10% bonds, primarily high-yield corporate bonds, and 10% alternatives, such as venture capital, private equity, and cryptocurrencies for high-risk, high-reward potential. Lastly, a conservative income portfolio. This could consist of 40% equities, focusing on dividend-paying stocks and stable sectors like healthcare and consumer staples. 50% bonds, mixing government and high-quality corporate bonds, and 10% cash and cash equivalents, like money market funds and short-term bonds for liquidity. Conclusion. Expanding on these investment strategies provides a robust framework for navigating the current market environment. By diversifying across asset classes, sectors, and geographies, focusing on quality investments, leveraging growth and innovation opportunities, and implementing effective risk management strategies, investors can position themselves for long-term success while managing short-term volatility. Please note that this video is for information and not for financial advice. Please like and subscribe to the channel. Thank you and have a nice day.